Today's Animal Spirits is brought to you by American Century Investments. They launched a new ETF. SDSI is the ticker. It is a short duration strategic income ETF, which has been wholly unexciting for the last decade. We're going to start the show today by talking about bonds. There was an article that just dropped in the Wall Street Journal. Bonds over stocks. Bonds over stocks. How about that? The new 60-40 portfolio.
Well, this is the kind of space where in the past you didn't really have to think about it. Now I feel like people have to be a little more considerate about their exposures to the bond market because rates are moving so fast in both directions.
So I'm looking at the portfolio here of this ETF. Weighted average coupon, around 4%. Duration, less than 2 years. I mean, this is unthinkable. And so even though bonds got killed last year and it was really uncomfortable transition from no rates to rates, like finally, we've got some fixed income in the fixed income side of the portfolio. It's a beautiful thing.
In shorter duration too.
So if you want to learn more, go to americancentury.com to learn more.
Allow myself to introduce myself. Welcome to Animal Spirits with Michael and Ben. Michael, the last few weeks we've discussed the fact that you can get much higher yields in short-term bond instruments now. You can get 4.5% or something in T-bills.
I don't know why the word instrument with bonds. I know that's what it's called. It's just, it's funny.
Okay. And sorry, I was thinking about that time, the word you used when we laughed really hard that one time. At least we did when we were at Barry's house. Anyway, so T-bills, short-term T-bills yield like 4.5%. And part of our argument has kind of been, well, this is finally some sort of competition for stock. So why wouldn't a bunch of investors just move a bunch of their money into cash, like especially retirees, people who are risk averse? Now we have through Friday, these are the returns for different various parts of the stock market. S&P 500 is up more than 4%. The Qs are up more than 5%. Russell 2000 is up over 7% this year. International stocks are doing better.
I am playing short-term bonds like a violin, Ben.
Okay, what do you mean? Jumping in and out?
No, it was a joke on instruments. By the way,
okay.
What was the word that it said at Barry's house? We could bleep this, but what was the word? Oh.
So in 2 weeks, stocks are up 4 or 5%, and that's what you get in a year in T-bills now, right?
Mm-hmm.
Potentially, as long as rates don't move that much. This is why people still invest in stocks even when yields are much higher, because you have that ability to earn money really fast, and people aren't patient enough. I always go back to this. Look at the next chart here. This is 10-year treasury rates in the 1980s. Going into the Black Monday crash in 1987, the 10-year treasury yielded 9.9%. Now, some people might say that part of the reason that crash happened is because rates went from like 6% to 10% in a very short period of time. But can you imagine seeing stocks drop more than 20% in a single day and not moving your entire portfolio into 10-year treasuries yielding almost 10%? So the question is, back then with 10% treasury rates, why wouldn't everyone have all of their money in 10-year treasuries? Right? And I think, the
I guess because you're coming off 15 years of inflation that destroyed bonds.
Yeah, but that's my point, is that you look at the rates in a vacuum and you go, oh, this makes all the sense in the world. Just take some risk off the table. But I don't think that we humans, we like to gamble. We like to see, I think we like a little bit of the action and the juice. And so even though bonds now provide a little competition, I don't think that our brains will allow us to just say, okay, I'm going to take the boring path now. I don't think a lot of investors are going to be able to do that.
You're so right. It's such a good point, and a point that great minds think. I was actually thinking about this week. So when I saw this in the doc, I was pleasantly surprised because I had a very similar thought. Now, here's another component: the value of future cash flows, which obviously, stocks are not valued off future cash flows every single day, but ostensibly, like that's the idea. And so when interest rates rise, the value of these future cash flows goes down. And so
in theory.
So you have those two things. It's like, well, I could either literally invest in bonds versus stocks and combine that with the fact that higher interest rates make stocks relatively less attractive, not even on the bond side of it, not even on like the should I, shouldn't I. But you're right. When you see stocks go up 7% in a week, you think you get that FOMO. Doesn't matter really. Bonds could be yielding 2%, 4%, or 8%. I think you're 100% right on that.
This is a weird environment for this too, because in the past, if stocks and bonds have zigged and zagged at different time periods, you now have stocks that were in a bear market and bonds that were in a bear market too at the same time. So usually you'd be able to switch from one to the other thinking, well, bonds just did good because stocks got crushed. Now maybe I can switch. But now it's they both just got crushed. And so I think they both look attractive. This is why for diversified investors, this is not the time to just throw your hands up and give up. This is the time where it's like, oh, these two things at the same time are finally relatively attractive compared to where they were 18, 24 months ago.
Could not agree more. Uh, we've been speaking about international stocks. I saw on the TV screen. So when I work out, not to brag, on Tuesday mornings, I've got CNBC on mute, obviously, because I'm talking to the guy on the screen. And there was a Bank of America, like they did their like fund manager survey. And best idea was overweight international or something like that. I forget how they word it. And a contrarian idea, was buy US stocks. How crazy is that?
Because they've underperformed for one quarter.
I've got a crazy listen. It's been a rough 10-day period for U.S. stocks, so I'm going to go out on a limb. I'm going to be a contrarian and I'm going to buy U.S. All right. So anyway,
So you have this tweet here that says what MSCI World ex-US is outperforming by 14 percentage points on a rolling 50-day trading basis, the widest margin since 2009, which makes sense because international stocks have gotten crushed since then. This has all happened in pretty much the last quarter. So this is since I think the market bottomed in like mid-October. So I found the MSCI EFA versus the S&P since it's like October 12th, I think was the bottom. And international stocks are up more than 27%. S&P is up 12% in that time. So international is crushed. And part of it is because the dollar has rolled over. But this is also the counterintuitive nature of investing because we talked last week, everything was left for dead internationally. Europe's a mess. China's still shut down, all this stuff. International, that was the easy one.
Uninvestable.
Yes. I guess that.
I definitely won't pretend to know anything about really the nuances of the European economy, or many economies, I should say.
What? You want to know what we need to know about European economy? They don't allow for free refills, and they don't put ice in your drinks. That's all you need to know. This is what I remember about traveling from Europe.
Ben spent a year in Vienna.
A summer. Those are the two things I remember the most. They don't have ice, and they don't have free refills.
There's a concert hall in Vienna. You know who said that? Leonard Bernstein.
Okay.
I think he said that. Something like that. So Jeffrey Kleintop tweeted, while economists are still predicting that GDP was negative in Germany in Q4 and will be again in Q1, this real-time indicator from the OECD is pointing to continued growth. So what's going on? Is Europe in shambles or is it not?
Again, that's the most surprising thing probably is the energy prices there. That people thought the energy prices were going to be this death knell, and it just hasn't been the case for whatever reason. I still have yet to hear a good reason for why energy prices crashed in Europe. People say, well, weather's mildly warmer, but doesn't it seem like every winter weather is mildly warmer? Isn't that every year for the past 15 years?
How's the weather in Grand Rapids?
It's mildly warmer than usual.
Same. It's like 40s or something.
Well, we've had like record amounts of snow, but every time it snows, 3 days later it all melts. So we've got no snow on the ground right now, which is pretty surprising for Michigan. The ski hills don't like that. All right. Another Wall Street Journal one. BlackRock versus Goldman in the battle for 60-40, which I feel like this is the new passive investing argument that we all had for 5 years and put to bed. Passive versus active. 60-40. So BlackRock actually saying 60-40 is kind of dead. They like commodities, private debt and equity, infrastructure, tips, all these things. And then Goldman says, no, 60-40 is still fine. This is a good one. Goldman calculates that U.S. stocks and bonds both lost money over 12-month rolling periods just 2% of the time since 1926. To show how out of the ordinary last year really was.
And the times that they did lose money over a rolling 12-month period, the 60-40 was probably down less than 5% if I had to guess.
Yeah, not as much as last year. My whole contention that I've always stated is if you really think the 60-40 portfolio is dead, then you're saying diversification is dead, especially over the long term. And the other thing is no one actually holds a 60-40 portfolio of just U.S. stocks and just U.S. bonds. Maybe Jack Bogle, he might have been the only person alive when he was, who actually had a portfolio that was probably similar to that. No one actually holds that portfolio.
So yeah, people like bonds. BlackRock, which we'll get into the quarter, had record flows into bonds. Here's a chart. Highest bond inflows on a weekly basis in 18 months. And it makes sense.
I would love to see the breakdown between short and long-term bonds there because it's got to be all short-term.
Short, yeah.
Unless you're really predicting a recession. But if you predict a recession these days, you know what the new recession call is? It's not just 40%. baseline is mild recession. No
Yeah,
one's, I mean, unless you're a zero hedge, tinfoil hat person, then you predict the world is going to crash around us and everything's going to be in shambles. But other than that, if you're a Wall Street strategist, you say mild recession, base case scenario.
Mm-hmm.
It has to be. That's the new 40%. All right. Gundlach is on the, he must be an Analyst Peers listener. He says on his webcast last week, this is from Jennifer Ablon, it is obvious the bond market is controlled and the Fed usually follows a 2-year treasury note. We talked last week about the market arguing with the Fed. 2 years rolling over. I put the effective Fed funds rate here. It's potentially still going to go up. I'm trying to figure out what the bond market is right or wrong about, because is the bond market falling because it thinks the Fed is going to cut rates, or is the bond market falling because it thinks inflation is falling?
This I don't understand. I have my do not disturb is on. I see it. It's on. How are messages getting through? Come on, Apple. Don't make me short your stock.
Mine's always on do not disturb. It never happens anymore. I just leave it on.
This is the first time I've had that issue. Usually they're pretty good about that.
So some people say the bond market is wrong and the Fed's going to be right this time because the Fed's not actually going to cut if we have a soft landing. But are bond rates falling because it thinks the Fed's going to cut, or because it thinks inflation's rolling over? We don't know, obviously, right? So I'm trying to figure out.
Sounds like we need to do a survey.
There you go. All right. Please tell me you put this next chart in here because it's a chart crime.
Oh, I did.
Okay. Thank you.
It's been a minute. What are we looking at, Ben?
This is from said Mr. Gundlach, who I disagreed with, and I'm going to disagree with. He's global central bank balance sheets and the FANG Plus Index. And honestly, anytime I see two different pieces of data on the same chart with two separate y-axes, I immediately throw that chart out the window, because it's so easy to manipulate these things by changing the range of the outcomes and the axes.
Well, listen, I've said it before and I'll say it again. There are only two directions, I guess 3 directions that a line can go: up, down, or sideways. Right? So if you want to find lines that go the same way, it's very easy.
That's why I just hate the charts that say this looks like 2008 or 2009 or 1929, because you can make any lines do that. It's not actually, that's not actually analysis. It's just it's a chart that wants to go viral for people who don't know how to read charts. All right, this is a good one from Dividend Growth Investor. 2022 was a record year.
Go on. I'm sorry, my bad.
Okay,
continue.
So S&P 500 price declined by almost 20% last year. Dividends went up by 11%. So dividends went from a little over $60 to almost $67 per share in 2022. That increase was higher than inflation. So dividend payments for the S&P have increased 13 years in a row, and they set a record for 11 consecutive years, which I guess makes it a dividend achiever. I think if you're a stock and you've increased your dividends for 10 years in a row, you're a dividend achiever. That's like I don't know, is that a millennial participation trophy award for the stock market? But that's pretty great, though, that dividends still increased over and above the rate of inflation last year in a really high inflationary year when the stock market was down. It's good.
Dividends are, they're undefeated. Unless they get cut, in which case they are defeated. But go ahead.
Real quick, this is Lawrence Hamtill tweeted this. I've never heard of this place before that did this piece, but this Lindsell Train Fund, I don't know. They said in 2011, remember Mark Andreessen wrote his famous "Software is Eating the World"? I guess in that, which is what's one of the most prescient pieces of this century in terms of like what's going to happen next for technology. It's interesting because that, on a trend basis, that was maybe one of the most right macro trend pieces, again, of this century. But they said that in the piece, he talked about specific companies. They said he discussed 17 then or since listed digital disruptors, more than a third of which have subsequently declined in market value since 2011. Some calamitously so, Groupon being one of them, which is down 98%. And then in contrast, he talked about 10 like old economy laggards, like these are the companies that are going to be displaced. And they say all of which have delivered positive real returns. This is one of those things. This is one of the reasons technology is so hard to invest in, because you could nail the macro trend and completely whiff on the companies that are going to benefit. Anyway, yes. I thought that was interesting.
I agree. Speaking of technology being difficult to invest in, there was an article, I think last weekend, in Barron's. Kathy Wood said, quote, investors are running for the hills, away from our strategy. They're running to their benchmark. Guess where there is more risk? It is in the benchmarks because the traditional world order is going to be disrupted and disintermediated here. I have two comments. One, it is a little bit weird that it sounds like she's like almost taunting. Right? It sounds like it's at a 15-yard penalty for taunting.
A little bit. Well, I mean, the biggest taunting, the biggest red card was when they did that index fund commercial
Ooh,
right at the peak.
Yeah. But it sounds weird to taunt in this manner. But in addition, if she's right, which, maybe she will be, if she's right about all of these disruptors, they'll show up in the index. They already do. And they'll get bigger, right? Maybe these are the next winners. But index funds will benefit.
Owning the S&P or total stock market index is the ultimate way to invest in innovation because the winners are eventually going to rise to the top. Guess what? All the huge tech companies, Apple, Amazon, Facebook, Tesla, Nvidia, none of those companies were in the top 10 in 2000, and now they are. So you had a winning innovation strategy. It just took a while to get up there.
That's a great point. All right, speaking of, I want to one of Kathy's one of ARK's biggest holdings. Feels disrespectful calling her Kathy like that. One of ARK's biggest holdings.
It's the second biggest holding, like a 9% weighting.
Is Zoom. And there's a chart that we're going to include for the YouTubers. You're already looking at it. It's showing the price of Zoom versus the revenue. And it made sense when you have a 4x increase in revenue for the stock to go bananas. But like every other time, it took it way too far. Probably tens of billions of dollars in market cap too far. And of course, you couldn't have predicted that. Guess what? They're not growing anymore. Like at all. The revenue is not growing. So it's not a surprise that this company lost 85% of that froth or 90% of it or whatever it is. And there's companies that are eating its lunch. So for example, how great is this feature that we discovered? Probably late to it, but for people that use Slack, I was not a fan of the huddle feature, which a huddle is a button that you click and it's audio. And it was a little bit choppy at first, but it's improved over time. Now there's a FaceTime feature on Huddle, which is like, essentially Slack. I guess it's not a schedule, but it's impromptu Slack. And Google Meets is another one, obviously that's doing very well. And I do have a bone to pick, or not a bone to pick. I have an idea for Google Meets and for Zoom. What I'm about to say sounds bad. I hate being late. I hate people that are late, but I've been tardy to too many meetings lately, and that's on me. My bad. I think an easy fix for this is instead of having my calendar notification notify me 15 minutes before, I probably need like a 30-second notification or a 2-minute notification. Or can you double up? Can you do like, hey, in 15 minutes you have a meeting, and then 2 minutes prior? Because here's what happens. I just keep missing meetings. I don't know how you do it.
How about this?
Here's what they should do.
No, how about it just pops up?
Well, excuse me. Don't steal my idea. I don't steal your idea. I don't steal your ideas. I never steal your ideas. I've never stolen any of your ideas.
I've got a great new idea for Zoom. Call me.
But that's a great idea. So we're on the same page. So the idea is that if it's on your calendar, it should just pop up automatically. However, not to catch you off guard, maybe, eating food or doing something you don't want to be doing. Do you want to enter the chat?
Right.
Done. Do it. Hello.
Yeah, that's easy. But you're right. Zoom has now I still think Zoom is my favorite one. But is it really that much better than Teams or Google Meets or Slack?
Everything's better than Teams.
Teams is the worst. It's now a commodity product, and unfortunately, they were the one who brought this. By them starting this, they created competition for themselves, and now it's a commodity.
It's kind of unbelievable. I don't know if you've ever seen like competition come in so fast.
This was another pandemic pull forward. So if you look at their annual price returns. In 2020, they're up 400%.
By the way, sorry, last thing. Speaking of Teams, whatever happened to Skype? Microsoft dropped the ball on that one.
Well, that's why they called it Teams, because no one would, the term Skype was just a redheaded stepchild. There's no way.
Oh, wait a minute. Teams is Skype?
I think they basically used the Skype technology and changed the name to Teams.
Oh, but anyway, they dropped the ball, huh? They had a 10-year head start, 20-year head start. We had Skype in college.
We used to use Skype for this podcast, remember? It was awful.
We did?
That was like the very first year of the podcast. Remember we had some janky software we used, and we would use Skype, and it was a really bad setup.
Yeah.
The stuff we have now is much better. Okay, Odd Lots last week. They had Neil Dutta from Renaissance Macro and Connor Sen, who's a Bloomberg opinion columnist and a good tweeter as well. and they talked about like where we are with the economy and talking about the potential for a soft landing. And I thought this was one of the most important things they brought up because I think because everyone assumed that a recession was just going to happen and that was going to cause the Fed to cut rates, and like people were making their baseline assumption that, and then figuring out what the branches are off of that path. What are the paths from that, that outcome? Now that the soft landing is on the table, people are figuring. So if a soft landing does happen, they were saying basically if households and businesses hunkered down for 12 months, assuming a recession was coming, and I guess you could say households haven't really hunkered down yet because they've still been spending, but businesses probably have. If a recession doesn't happen, is a soft landing inflationary? Because it could mean people think, all right, well, it's not happening anymore. Let's ramp up investment and research and development, all these things, and in spending.
I'm gonna say no.
Because
I think the ship has already turned. The battleship has already turned in terms of retrenchment. Number one. Number two, a lot of the inflation in the first place obviously was driven by supply chain disruptions.
Yes.
And demand. I don't want to minimize demand, but you have that side of it fixed. You have the people are already retrenched, and they're not all of a sudden gonna be like, oh, we just soft landed. You know what I mean? Like there's no like,
but even
ding dong, soft landing. We just did it.
But even a normalization versus a recession, I think is a different case. And I think what this really does, I think this is probably the scenario where you'd see rates actually be able to stay higher for longer. Because if there's no recession, the Fed doesn't really need to cut unless inflation went to like 1% and the Fed's going, whoa, we're way ahead of the ball here. Maybe then they would cut a little bit or stop. But this is the scenario where if we get a soft landing, that's when the Fed can keep rates at 4.5%.
Well, how about this? Let me ask you a question. And if you don't mind passing this along to Jerome, if inflation comes down to their target at 2% without a recession, should they cut rates?
It's possible. The other thing is,
wait, that's it?
Well, no,
It's possible. You have an opinion?
I have an opinion. I have an opinion. Going off of this, what if the Fed's whole thing was, and all these economists said, to bring inflation down, we need the unemployment rate to rise. We need to go into recession. That's basically like what they thought we needed to do. If they now have this scenario where we have a soft landing and the unemployment rate is still falling, like maybe what the Fed's doing is not actually helping at all. It's not doing anything. And maybe this stuff was going to come in anyway.
Oh.
And if you look at the inflation rate, if you look at the inflation rate coming down in the future, from inflation going from 0 to 9 and now back to 6, if it goes to 2, it's going to look transitory in the rearview mirror. Now, we lived through this. So it definitely went a lot longer than people thought it would, but maybe the Fed's whole prescription for this was wrong, and they thinking they had to jack up the unemployment rate. If it doesn't happen and inflation still falls, are they going to look themselves in the mirror and go, wait a minute, maybe what we thought we had to do was totally wrong to begin with, and maybe not trying to throw millions of people out of their job, maybe we should take that off the table for the future.
Well, I will not be part of the litigants that debate, was it transitory, was it not transitory? Let's just move on.
Yeah, I'm just saying, in 20 years, if you look back and that was the peak and it goes right back to 2, people are going to look back and go, oh yeah, that was an inflationary blip.
Yes.
We lived through it, so it definitely went longer than people who were saying it's transitory thought it was going to. But it's going to look transitory in the future.
So Connor Sen also tweeted, UMich consumer sentiment current conditions rose to its highest level since April. Gas prices down, unemployment at 50-year low, 3-month inflation very low, blah, blah, blah. It's all good. So we just spoke about the consumer survey. Nick Timiraos tweeted about the Philadelphia Fed president, Peg Harker, who said it's time to put more weight on surveys and other soft data. And as an anti-survey podcast, I don't know how I feel about this. He said, quote, candidly, an overemphasis on hard data can lead to policy errors. I like this outside of the box thinking. I like it. I need time to digest, but my knee-jerk reaction is I like this. However, there was a survey today that was really ugly. So maybe I don't like this. New York Factory, the New York Empire State Manufacturing Survey, fell to its lowest level since May 2020. New orders and shipments declined substantially. Delivery times held steady and inventories edged higher. Employment growth stalled and the average work week shortened. Input prices increases slowed considerably. Blah, blah, blah. All right, whatever. Anyway, it plummeted. That's not good. What happened?
I don't know. everyone was getting drunk watching the Giants game this weekend?
Should I? All right, let me tell my quick Minnesota story. So,
Also, are you just going to be wearing Giants gear for the rest of the playoffs now every day?
well, if we continue to win, all right. So Minnesota was not cold for a minute by Minnesota standards, but it was still freezing. Like it was 30, but it felt like 10. And it was very much an indoor city. Like it looked pretty desolate. Not a lot of people on the streets. You know, it's cold. It's a cold gray city. However,
Don't they have some
great
sort of like
people.
tunnel system or something you can walk
They
around in
did. Well, a
downtown?
lot of the buildings are like connected. Great people, great fans, great stadium, great seats. Thank you again, Luke. So the stadium is incredible. It's the best stadium I've ever been to.
Really?
And the loudest by far. So in the first quarter, I could not hear what I was saying to my friend who was sitting directly next to me. Could not hear. So the fans were very welcoming. Got a lot of beat. Kick Philly's butt next week. So when we sit down, and Luke gave us incredible seats, 20 yards behind the 40-yard line, behind the Giants bench. So everybody in the stadium is in gear of some sort. You're either Giants gear or Vikings gear. The gentleman who sat down next to me was a big hulking guy. Did I tell you this yet or no?
Mm-mm.
Okay. Big hulking man, probably 6'6", 280. You know, and he sits down, and these are like big wide seats, but still, like his arm went over. I'm like, ugh. You know, this is kind of annoying. And him and the guy next to him were not in Giants gear. So the guy, not directly to me, but one seat over, I said, oh, like, what are you guys, Giants fans? Because I'm like screaming my face off. You know what I mean?
Mhm.
Just every time Danny took off, I'm screaming, like, run, Danny, run, you know, just screaming. And so the guy 2 seats down from me said, I'm here for work. I've been here for work for a year. We're Giants fans. The guy next to me said, oh, where are you from? North Carolina. Oh, cool, whatever. You know, and I probably high-fived him a few times. I can't even remember. But at the end of the game, so at halftime, the big guy directly next to me went to the row behind me, which of course I didn't pay much attention to until the guy 2 seats down from me when the game ended goes, do you know who you sat next to for the first half? Daniel's father.
Oh, really?
How f***ing crazy. I sat next to Daniel. So Danny Dimes, that's a quarterback, this little goat right over here. Danny Dimes' father, I sat next to for the entire first half. And can you imagine what a great experience I gave him? Like screaming, go Danny, go Danny, go Danny.
I can't imagine watching your child play professional sports in a game with that much on it. Just watching my 8-year-old play sports right now gives me like butterflies.
Well, now I know where Danny gets his temperament from because I was going way more nuts than his dad was. His dad was incredibly cool, calm. And at the end of the game, he was such Mr. Jones, what a mensch. He said, that was an Eli-esque performance from Daniel. And he said, quote, but Daniel's a little bit faster than Eli. So he goes, so what are we doing after this? And my friend goes, I don't know, what are we doing? Anyway, there was no partying with Mr. Jones, but what a trip. What a trip.
And I'm sure dry January held up fine for you at the game. Right?
So here's another thing how you know you're not in New York. They gave out like I didn't pay for a drink the entire time in the stadium. We had several beer vouchers. Put it this way, enough to not pay for one.
Really? Came with the seats?
Came with the seats. They were just giving them away.
Wow.
So anyway, what an experience. Great people, very hospitable fans.
We were Giants fans for the weekends, just for you. Me and my kids rooting on the Giants.
Man, what a win. All right, let's maybe skip a little bit of this.
Yeah, we can skip some of the charts.
So we spoke about like the state of the economy and the slowdown and not slowdown and whatever. Tweet from the transcript. Rolls-Royce CEO, quote, we haven't seen any slowdown or downturn. We haven't seen any negative impact. I'm not saying we're immune from recessionary tendencies. We have seen years when our business was affected. I'm cautiously optimistic about us delivering another strong year in 2023. Now, there is a very specific clientele that shops at Rolls-Royce, of course, but you would expect them to see if there was a big slowdown, right?
I also think I think rich people have probably seen, this is generalizing, the worst of this as a recession. Tech people who are relatively rich, stock market down, bond market down. Rich people, the top 1% hasn't seen their income keep up with the bottom 25%. Rich people have probably seen the worst of this slowdown so far, if there is anyone. And they're still buying Rolls Royces. One more anecdote piece for you. on Christmas Eve, we were trying to go bowling. It was a huge blizzard here, and the bowling alley was closed. So we went to the only restaurant that was open, right next to the bowling alley. Kind of, there's a cheesecake factory. My kids loved the cheesecake factory. It's relatively new here. Kind of a touristy kind of place, but my kids loved it. It's kind of a cool indoor looking place. So yesterday there was Martin Luther King Day, and the kids wanted to go out to eat after my wife took them to see Puss in Boots, which all three of my kids gave high scores to. They like Puss in Boots. So we went to Cheesecake Factory again for lunch, and the waitress brought waters for the kids. They usually bring a water with a top on for the kids so they don't spill them, because of course they didn't give us tops, and of course my daughter spilled hers everywhere because that happens every time.
Naturally.
She said, "Sorry, we're all out of tops. We don't have any. We sold out this weekend." And we're like, "What?" Okay. She said this weekend was the busiest weekend we've ever had here. We broke all kinds of sales records at the Cheesecake Factory. Just a random weekend. I don't know if they had some sort of deal going on, but she said it was the most sales that they've ever had at that restaurant before.
Well, I
People
can
are still spending money.
I have some anecdote, and by the way, I just Googled desolate because it means what I think it means, and I shouldn't have said it because it sounds very bad. Here's a definition of desolate, which I used to describe Minneapolis: deserted of people and in a state of bleak and dismal emptiness. That was a bit harsh. What I meant was it was called that there was people were indoors. That's all. So
yeah,
I take it
that's
back.
what happens in the Midwest in the winter, though. You don't see a lot of people outside unless they're doing outdoor stuff.
Yeah. But when we went to like the sports bars, they were packed. And anyway, so JFK, I flew out Sunday morning, and the line to get through security was 50 minutes, 50. Not for me, I have TSA pre-check, but 50 minutes. It felt like a Christmas travel day or something, or Thanksgiving, or whatever the busy travel days are. It was insane. Maybe MLK is a big travel weekend, but it was Sunday. Oh no, it wasn't. It was Saturday. It was Saturday.
I think people
Be that as it may, airports are still booming. All right, let's get into inflation real quick. Bill McBride tweeted the most. So we had inflation data. That was last week. Yeah, last Thursday. The most important inflation number currently is core CPI X shelter. This was negative month to month for the third consecutive month and is now up only 4.4% on the year.
So we talked earlier how the stock market is up this year. We had a few people ask us, well, we had a great inflation report in December. We had a great inflation report in January. Why aren't stocks ripping? I actually think it's probably a better. Well, they did a little bit, but not. I think people are now accustomed to, because last year everything was so volatile. People want to see like a 3 or 4% up day in one day. Maybe that not happening, and this year being a little more boring than last year in terms of huge up days and huge down days. Maybe that's a win for the stock market if that happens. Even if we don't see like 20% gains this year, maybe if we just see muted gains, but we don't see all the volatility, that's actually a good thing because it's kind of a normalization of the stock market.
I'd certainly take it. Michael McDonough has this chart from Bloomberg showing he breaks down the inflation components. And energy rolled over very hard. Goods rolled over very hard. But you know what has not yet peaked? Services, ex-food and energy. So to your point, Cheesecake Factory, airports, flights are really expensive. Really expensive.
Yes. From what you expected before this, they're definitely taking advantage.
You have a great take about eggs.
Okay. So a lot of people have been talking about eggs. There's been a lot of egg content on Twitter too. People, every time something goes up in price, people tweet, "Take me somewhere expensive," and show a man and a woman eating a candlelight dinner. And first it was lumber, then it was, what was after lumber? Used car lot, and now it's eggs. Egg prices are up a lot because
eggs are delicious and they're great value.
No, it's because of the flu thing, the avian flu. So a lot of the birds are dying, and I think so it's hard to get eggs. So it's a supply thing.
I did see the 11 million hens have died recently.
So yes,
or 15.
so I think someone quoted me saying that there's like 1 billion chickens in the world, some ridiculous number. But so
somebody also tweeted to you, let Batnick go on. So you were defending. Somebody goes, let Batnick go on CNBC with this take.
I said this I was kind of trolling a little bit, but also half serious. I said, everyone keeps complaining about eggs being too expensive, but I'm going to zag. The national average for eggs is $3.60 for a dozen. And I said, that's basically like 3 to 4 high quality protein meals for less than $4. I think eggs have always been relatively underpriced relative to other forms of protein, and they still remain relatively cheap. And I had all these people in my mentions. I got roasted for this one for being elitist.
Well, you're an elitist. You are an elitist.
All these,
you're an egg elitist.
The funniest thing is that people don't understand how averages work, because all these people from California and New York go, "I'm paying $7 for a dozen eggs," and I wanted to tell them that's That's how averages work, because the high end, you people are paying high prices and people are paying lower. That's what makes an average. I think I saw 450 at our grocery store yesterday, and that was kind of the higher end grocery store. Anyway, I still think eggs are a really great. If I was a broke college student again and I was, lifting weights like a maniac, like I used to do when I played football, I would buy tons of eggs. That would be my main source of food and protein, because for a cheap college student, they're cheap and it's a lot of good protein.
Uh, Here, here. Eggs are great. Big fan.
You should eat some more eggs maybe for your workout because you're trying to build muscle.
My kids love hard-boiled eggs.
Hard boiled, okay.
But I'm not a yolk guy. I never was. I don't eat the yellow.
Get the egg whites.
No, I eat scrambled eggs. I'm just saying, like when I hard boil them, I give my yolk to Bianca, my dog. All right. Used car prices just dropped 14% year over year, 14.9% year over year. Thoughts?
This is good. This is the one that we've been saying all along. This has to be transitory. Used car prices can't keep going up like this, and it was ridiculous. Did you see Tesla cut their prices? Like pretty good size price. Like the Model 3, they dropped it by $5,000, I think.
It's down to 10 basis points.
What is?
That was a bad price cut, Chuck. Sorry.
So they did like almost like a 10% cut across the board for Tesla. Now, I can't tell if this just means a lot of people have just jacked up their car prices in the last year and they're trying to normalize them, or if this is a bad thing for Tesla. But this actually made me look at Tesla because I'm getting close to the point of when my next lease runs up, I want to get an electric vehicle probably. And I looked at like the Model Y, because you can get a third row seat in there. It's probably still too small for having 3 kids and a bunch of stuff.
Is that like the minivan?
Yeah, it's like their minivan SUV kind of thing. Probably still not big enough, but them showing that price cut, I did look at it.
How much is this car?
50. That's too expensive for my taste, but it's not because the other ones are coming way up,
How much are other electric vehicles of this ilk? I don't know if I used ilk there, but you know what I'm saying.
Well, that's the problem. They don't have a lot of good electric vehicles for SUVs with a lot of room. They don't have that yet. I'm waiting for my Ford Explorer electric vehicle. Make this happen, Ford.
Yeah, but that's going to be like way expensive.
Probably.
That you'll splurge for?
Well, I'm saying it made me want to look at a Tesla. I think I would consider it potentially.
All right. Well, it took a while, and I don't know if it's anything to celebrate just yet, but it's a step in the right direction. GBTC, the discount has shrunk from an unholy level. What was it at the worst? Did it get down to 50? 40. It went from the negative 49% premium to a negative 36% premium. That's a huge, I mean, it's still not great, but that's a huge move.
It's up another 9% today, the fund itself. Someone was saying that this is the kind of thing where it was such a huge discount and there was not much volume being traded that if you put, I don't know, tens of millions or maybe $100 million into this, you could potentially move that discount on your own. Because unless someone knows something behind the scenes, they're not saying something, what else would explain this?
Well, there are efforts to get
close it,
DCG out of there. Maybe I don't know the mechanics of this, but
so you texted me this weekend, and was it Friday night? You said Bitcoin's back above 20,000, and this is the reason that picking a bottom in the markets is so difficult, because I would have bet my life on the fact that Bitcoin was going to 10,000 with everything that happened. The fact that what did it get? It never went below 15, right?
That was very surprising. That was very surprising.
I mean, you could have been one of these people that said, you know what, I'm a Bitcoin bull, but I'm waiting until Bitcoin hits 10K or 9K, and then I'm going all in. Because that seemed like, with all the stuff going on, it seemed obvious that was going to happen, and it never happened. And now Bitcoin's, I don't know if it's gonna, it could obviously still crash again. But the fact that with all that stuff going on, and then add to all the stuff, and then FTX happened, and then it didn't completely fall down and crash is really surprising to me. And that's why,
really surprising.
If you're one of these people that's trying to just nail the bottom, I think I've told this story before, but I followed a guy in my old life in like July 2008. He says, I'm going to cash. Financial crisis stuff. He basically predicted what was going to happen. And then in like February of 2009, he lays out his time frame, and he says, when the S&P 500 hits 600, I'm putting 25% of my work to there. When it hits 575, I'm putting 25, and all the way down to 500. When S&P 500 hits 500, then I'm going to go all in. And the S&P never got to those levels. I think it bottomed at 666 and took off, and he sat in cash for 4 years after that. And he was right
Yeah.
on
Yeah.
so that's why like picking bottoms is so hard. It's like just get close enough. Don't try to nail it perfectly. If something's down a lot and you want to own it, just own it.
So Carl Quintanilla tweeted this from Bank of America on Coinbase. Volume in December were just $34 billion, less than half of coins first quarter to third quarter, monthly average of $76 billion. We think consensus revenues for 23 could be way too high. Lower price PO. What's PO? Price opinion? No. What's
Price
PO?
objective?
Whatever. Okay. Yeah, there you go. To 35 bucks.
Is this the kind of thing where their earnings don't matter? If Bitcoin's going up, Coinbase is going to go up. If Bitcoin's going down,
you're
Coinbase
100% right. You're 100% right. And guess what? Yeah, I'm sure once we get their Q4 earnings, the volume is going to be down bad, like really bad. But we're going to talk about some activity returning to the housing market. How quickly do you think trading will come back to Bitcoin if it goes to 25,000 or 30,000?
People will, if it goes to 30 and it effectively doubles, that people will get interested again. Yeah, I think you're right.
All right, I want to get rid of this.
Analysts who predicted Bitcoin would hit $30,000 this year now thinks Giants can win the Super Bowl.
Well, that I will not that I won't say. Although I will say, if you're asking for my opinion, I think the line is too high.
What is the line right now?
It opened at 7.5. And I would have told you. So the Eagles, they killed us the first game. The second game doesn't matter because nobody played. But we're healthy. I think we have a chance. I
think strange things can happen if you play a team for the third time in the same season.
I expect us to lose, but I also expect it to be a good game. Like I don't think we're gonna get blown out. But this season it's all gravy. We're playing with house money, so I'm good either way. All right. So something is dead here. Shame dead?
Pride.
Anything? Yeah, something's dead. So what I mean is the guys from 3 Hours Capital, who were the ones that really took down the whole system. Maybe that's an overstatement.
Are they on the run? Are they on the lam? What? I don't know where that stands with them.
I think so. They were huge investors in the Terra Luna situation. That collapsed. They collapsed. GBT collapsed. I mean, the whole thing. It was, the cards fell very quickly, and they were maybe the first domino. So anyway, these guys, Su Zhu and Kyle Davies, are trying to fund or raise money for a centralized exchange. What? What? And guess what? There's 2 other guys on the investment deck. Could you imagine those 2 guys going into business with these 2 guys?
I feel like that's the kind of thing where if your venture capital firm invests in this, you say, "Give me my money back immediately." Just you're done. That's enough. I've seen enough.
So Larry Fink said on CNBC, "I look forward to the day when all stocks and bonds are tokenized, so we know every beneficial owner of every stock and bond." Yeah, of course. I bet he does wish that. I was thinking about this as I used my Apple Wallet for every ticket that I hold, right? And I use Apple Pay all the time. What if that's just what if that's an application that we don't even think about, that stuff runs on the blockchain and it's just like sort of seamless, like, and people get more comfortable with the idea of like digital wallets. Counterpoint, I got a Giants NFT from the ticket, which I was super psyched to get because that's my idea. Like I want to be able to remember this. Not that I wouldn't remember it, but anyway, it didn't work.
Yeah,
the delivery did not work.
The funny thing is though, if Larry Fink says this when Bitcoin is at 70,000, people are going nuts over this all day. And then he says it now when crypto's in the winter.
That's true.
Yeah, no one cares.
That's true. So all right, so I mentioned that activity in Coinbase or trading activity could pick up real quick if it hasn't already. Lance Lambert tweeted, and I've been on this. Lance Lambert tweeted, "A Seattle real estate agent tells me, quote, for what it is worth, the first 2 weeks of the year have been busier with buyer activity than the last 3 months combined were," end quote.
There's a lot of pent up demand there.
Haven't we been saying? If interest rates, missed the boat, if mortgage rates come back down, there's going to be a flurry of activity in the housing market.
All right. Fed Woj tweeted this study saying home price gains over the last 2 years could have produced a wealth effect for homeowners that drove 1/3 of the increase of CPI, non-shelter prices. I don't agree with that. And he put a counterpoint here to saying strategists at BCA Research note that home price gains were so swift that consumers probably did not fully adjust their spending patterns to incorporate their newfound wealth. So I agree with this. So I think the wealth effect is probably stronger from low rates and low payments than from higher prices. I don't think people see my house price going up. I mean, I borrowed a little bit more against it for my home equity line of credit, but I didn't spend more because of that. You know what I spend more? If my monthly payment goes down after I refinance. So I think the fact that people going to lower payments, and I don't think we still. So Connor Sen tweeted about how the mortgage debt service ratio is still near record lows, and this is something we've pointed out. I don't think we've fully comprehended how much of a long-term boost that gives for people who locked in these low payments. I mean, that's not just a one-time deal. That's a long time. That's a long term. You've locked in a low payment and you now have more spending power that you would have been putting towards your shelter costs.
Yes.
That's a huge, huge boost.
See,
And I think
yeah.
maybe one of the reasons that people kind of underestimated things remaining stronger for longer as they have.
And so there was activity, but remember early on, or during the housing boom, that there was no what's the word I'm looking for? Buyers couldn't put anything into the contract. There was no, what's the word?
No, well, you couldn't negotiate at all. There's no contingencies.
There it is. There you go. There was no. Thank you, Ben. There was no.
Your vocabulary was very desolate right there for a sec.
We're mind melding. There was no contingencies on many of these deals, which is insane for the biggest purchase of your entire life.
Right.
Well, now again. This is Ryan Lundquist on Twitter. He said buyers are getting more from sellers. Last month, 51.5% of all sales in Sacramento County had some form of a concession. And we've got this chart over time, percent of sales with concessions in Sacramento County. And this is what you expect. So activity's picking up, but now the balance of power has shifted from sellers to buyers.
Right. I'm going to put new carpet in, so I want you to take another 3% off of the sales price or whatever it is.
Right. By the way, I know people are probably sick of me talking about my mudroom. I'm just flabbergasted at the quotes that I got, given what I just saw. So I basically, you know what I did, Ben? I put a wall in my garage. I cut my garage in half. That's it. They put in a wall and they put in a floor. And this guy was quoting me $30,000. Is it what? I feel like what I spent, which was a third of that, is still too high.
Does seem high.
It's a wall and a floor.
Yeah, but you got lockers to put in. Yeah.
By the way, those that's a separate cost. That doesn't come with it. That doesn't come with it.
You're not getting for that money. You're not getting like built-ins for those. That's separate. The GC, I paid him for hi-hats, a floor, and a wall, and some paint and sheetrock, whatever. All right, Mike Simonson tweeted, a single percentage point decline in rates has the same impact on affordability as an 11% decline in house prices. So that's rates going from 7 to 6, then maybe 6 to 5. Obviously,
I wonder what happens the other way.
Well, no, it's the same thing. That's the counter. That's why affordability got so bad, because it's the same thing on the way up.
Yeah,
rates going up, so that's why affordability got so bad. We've talked about this before. You asked who in the world is refinancing their mortgage. Mike Zaccardi tweeted this at me. Almost 90% of mortgage refinance volume in Q3 2022 came from cash out transactions. So that's it. People who have some equity, who need it for some reason or want it, are taking money out. Even at higher rates, that makes sense. All right, we get a lot of questions from people in other countries about their mortgage and what to do. This is from friend of the show, Logan Motashami. Did this tweet. It compares household debt as a percentage of gross disposable income to share of adjustable rate mortgages for new issuance. And the United States is at the bottom left of this. Look at some of these other places. Norway, Australia, Sweden, Finland, Denmark. Way, way more debt, consumer debt. And they have...
I'd love to know I'd love to have some color on this. Like, why is it so prevalent that they do that?
My guess is just it's always been that way, but they have like 70, 80, 90% of mortgages are vulnerable to rising rates because they're adjustable rate mortgages.
Oh, but you know what else is interesting? Is it correlated with on the other axis, they have household debt as a percentage of gross disposable income?
But if this was the case in the United States, and we were looking down the barrel of 6% mortgages when you had a 3 because it's adjustable rate, we would be rioting at the steps of the Federal Reserve building.
Right.
They would not allow the Fed to keep rates this high if that was happening.
Doesn't this look like the more indebted, the more likely they are to have adjustable rate mortgages?
Yes. So obviously that was a good thing when rates were falling. It's not a great thing when rates are rising now.
Interesting.
Yeah.
All right, we're already running late, so let's just Want to shout out to the quarter app because it's earnings season. It's earnings season. All right, iShares. This is from BlackRock. iShares did $123 billion in inflows. 6 of the top 10 asset gathering bond ETFs were iShares. Did you know that?
No, that's interesting.
6 of the top 10. They spoke about short duration, having massive inflows. Again, we've been discussing that, not surprisingly. They talked about where rates. Okay. All right, some good stuff here. Since our IPO in 1999, BlackRock has delivered a 7,700% total return to our shareholders, which is wild. The strongest return of any financial services company in the S&P 500 over that period.
That is.
Do you think you would? I guess that makes sense. No.
Well, yeah, a lot of the other banks and stuff got killed, and they probably didn't in 2008.
So the stock. How does the stock look? Stock looks good. It's hanging in there. Here's a stat that was on the conference call, I think. In the U.S., yeah, it's from the conference call. ETFs only represent 2.3% of the bond market. How about that?
Yeah, that's surprising. Man, so since inception, that's almost a 22% annual return for that stock. And think about the stuff that I mean, obviously the business has a lot more stuff in it, but now they're dominated by low-cost index funds.
So they have a chart showing the net flows. And the only thing that's really negative is retail long-term. I wonder what this means exactly and how they parse this out.
Like people who buy and hold index funds?
I guess. I don't know how they would identify that.
It's a good question.
But, all right, JP Morgan, record revenue. How about that? Despite investment banking revenue being down by 57% and banking fees were down 58%. What is in this chart that I wanted to highlight? Home lending. Ben, look at this. Home lending.
Jamie Dimon predicted his 7th recession out of the last 0 on this call.
So home lending got cut in half from a peak in the 4th quarter of 2021.
That makes sense. Do you think there'd be nothing coming in on that route?
All right, check this out. Look at the financial results. Net interest income, $20 billion, up from $2 billion in the previous quarter.
They're still not paying anything out to people who have a savings account there.
What is a savings account yield?
I bet it's 20 basis points or lower. It wouldn't shock me. They're probably paying money market funds now, but savings account, they're probably still paying nothing.
So look at this. They've got their card services, 30 plus day delinquency rate. I mean, does this look scary to you? Yes, it is going up, but that's only because it was so low.
That's why, honestly, the Kyla Scanlon last year vibe session thing was the perfect explanation. People just felt like things were going to get bad or going to get worse, and the results never showed it, besides inflation. All right.
What do we have on the docket for this week? I think Netflix is this week. All right. We had banks. We had Goldman this morning getting killed, I guess, because they're just all investment banking. Morgan Stanley's doing much better. I guess it's wealth management, if I had to guess. We've got United Airlines on Wednesday, Netflix on Thursday, #long, not selling. Costco.
So you're a long-term retail trader now, investor now.
Well, I'm in this for the long term.
The New York Times had this story about how much income you make, and they asked people on the street how much money do you make, because New York has this new thing where a law went into effect that if you have at least 4 employees, you have to disclose a salary range for each job listing. This stat blew my mind. In 2021, the median household income for New York City was, what do you think?
Hold on.
Median household income in New York City.
97,000.
70,000, roughly the same as the rest of the country. I don't know how people with the median income of the rest of the country can afford to live in New York City.
I think they live in the outer boroughs. There's no other explanation.
It's just crazy to me that. So a few quotes kind of stuck out to me. They said a stockbroker dressed in a plaid suit with a floral pocket square was happy to talk. At first, he eagerly told us that he made $300K a year. But as we continued to speak, he became embarrassed that he didn't make more. In the end, he withdrew his quotes, which is totally a New York thing. Anyway, a bunch of good quotes in this. I thought it was interesting. One more thing from the Atlantic. They talk about dual income families or non-dual income families where one person works, the other person stays home with the kids. The average pay for people who have both spouses working is a little over $100,000 a year. This is from a Pew study of 2-parent households. Families in which one works and one stays at home made about half that, $55,000. But they said those families that have both parents working report feeling pressed for time. 40% of moms working full time say they always feel rushed. Half of dads who work full time say they don't get enough time with their kids. This is the trade-off we always talk about with daycare, where you can either both work and make more money, or you can have one person not work, make less money, but then you have the trade-off of time and feeling rushed and busy all the time, and there is no easy answer.
Yeah, I feel bad for my wife that, well, this sounds ludicrous. I don't feel bad that she works, but I feel bad that I have time with the kids in the morning because it's like the best time. Right. She's gone before they leave. So I feel like she's missing some of the joy that I get to experience. With them from 7, I'm with them for an hour. It's terrific. It's wonderful. It's the best.
Yeah. There really is no good answer for anyone who says that there is. It's the trade-offs are
well, it's just, yeah. Where do you want to sacrifice? Because you will be sacrificing something. Bed and Bath. How is this possible, Ben? What happened? I know we've spoken about this company many times, but just did they just get killed by e-commerce?
I think Amazon just put them out of business. The stuff that we used to go to Bed Bath & Beyond for,
that's true.
now we just get it at Amazon. I think Amazon was a Bed Bath & Beyond killer.
Yeah.
I mean, everyone went there right when you get out of college and get your first place. You go there, but now it's so easy to just go. My favorite Bed Bath & Beyond store, we had one that was probably a half mile from our house. The first house we moved into, we got some outdoor furniture, and my wife and I both drove sedans. I drove like a Nissan Altima. She drove a Honda Accord. And we couldn't fit the outdoor furniture into either of our cars. And I had to borrow the huge cart from Bed Bath & Beyond and walk it down the street to our house a half mile away and then bring the cart back because it wouldn't
Remember,
fit.
I said...
now you get that delivered.
I said sometime... yeah, that's exactly right. I said last year that it was by far the worst. I've never heard an earnings call that bad, so alarming, where the analyst just went like, best of luck.
Right. They just knew writing on the wall. Look at this. I put this chart in here. Since inception, which is like a 1993 IPO, the stock is up 50% in total. It's 1.4% per year. At one point, they were up over almost 8,000%.
So at one point, it was probably compounding at 30% a year. I definitely owned this stock in the early 2010s. I'm positive I did.
And it was a really good stock then, it looks like. And it's just completely crashed.
All right, here's...
what are they going to do with all those? Are they going to turn it all into Jake's Fireworks and Halloween whatever depots when it goes out of business? There's so many Bed Bath & Beyonds in every suburban place, every suburban mall, or
they just get leveled. They just get leveled.
It's like Toys R Us, I guess.
There's too much space. Somebody tweeted, not a good sign for Mastodon. The past 2 months represented one of the best environments for the service to get new users. Data shows few joined, and a large portion of those who did join are now losing interest. You can't replace Twitter. I don't think this was like.
I don't think so either. And the people a lot of the people who left Twitter and said, "I'm gone, sorry," they're slowly come back. It happens. Sorry, it happens to the best of us.
So I've made the point that the best inflation hedge, for me, at least a good one, was the Starbucks rewards cards. And here's what I mean. For a hot coffee, and I guess the jig is up, for a hot coffee, I could put in as many shots as I want. It could be the largest size. It could be a $9 hot coffee if I really go nuts. And guess how much it cost, Ben? 50 stars. 50 stars. And it never went above 50 stars. Although I don't understand, because the cold coffee is 150 stars, even if it's like a third of the price. You could get a cold coffee for $3 and a hot coffee for $9. And it's still 50 stars for the hot, 150 for the cold. Anyway, somebody either emailed or tweeted or whatever said it was an overcrowded trade, and now it's going against us. It's going up to 100 stars instead of 50 in February. It's tough.
Inflation.
That's tough. All right, so we lost another babysitter. We just go through them like water. I think this is our fifth one.
It is really tough to find.
After school, the kids get off the bus. It's a tough spot to fill. Kids get off the bus at 3:15. We have a babysitter here until around 5:30. And these are generally young women who are in college, right? They're it's not a full-time job by definition. They're going to move on into the workforce. But so anyway, so Robin said it happened again. I said, what happened? She had an externship. So I said, what the hell is an externship?
That just mean you get paid?
Robin said it's an internship, but the opposite. And I went, what does that mean? What's the opposite of an internship?
Okay. I've never heard that before. You know what we need though? You need a DoorDash for babysitters. Like put in your DoorDash. You have on Friday nights it's gonna be way more expensive, but during the afternoon, you call up and say, I need 2 hours, babysitter dash.
I don't know
for 2 hours.
I don't know if people would be comfortable with that. unless there was a review system, right? Like, which I guess there would need to be.
People became comfortable with Uber though, right?
Yeah, that's true. That's true. Although kids in the house,
True.
Anyway, first world problems for sure. All right, Ben, you were talking about like ChatGPT and how what you needed to do. Well, guess what? It could do it. Somebody said, email this to us. List the last 10 recessions and the performance of the S&P 500 during those recessions. So what we really need to do is go a step further and put this in a spreadsheet for us.
There we go. Now we're talking. Yeah, give me the data. All right.
I'll
start using it when it can help me with blog posts. How's that sound?
All right, we're done with this. All right, let's just skip all of this. Do you think this? Okay. Do you think this is real? Darren Ravel tweeted. I mean, when the Chargers were up 27-0 and they lost 31-30. Somebody bet $1.4 million for the opportunity to win 11,200.
I don't.
They said it confirmed the bet was indeed made.
I don't buy it.
This is the worst trade of all time.
Yes. Yeah. There's no way this happened, right?
I can't imagine. All right, let's move on to recommendations. We went long.
Put your money in a bank account. All right, I think the Golden Globes got me into this because it won a Golden Globe for something. I watched Everything Everywhere All at Once. It's now on Showtime.
Did you watch the Golden Globes?
No, but I saw like the list of who won.
Did you see Jennifer Coolidge's acceptance speech?
I did not. I didn't really watch much of it.
Okay, she tore the house down. She was very funny. Did you see what Eddie Murphy did?
Okay, I saw the Eddie Murphy thing.
Yeah, that's funny.
I saw that on Twitter.
That's funny.
So Everything Everywhere All at Once was an ambitious movie, and I felt like the first hour was awesome. I really liked it because it was creative. It was different. I don't know if it was based on something. I didn't know much about it going in. I didn't realize
it's based on a true story.
I did not realize that the guy from Indiana Jones and Goonies was in it. Holy cow!
Totally blew my face. Yeah.
Goonies is like one of my all-time favorite 80s movies.
Wait, did you like it?
I thought it was really great, and it was like they took a huge swing. I thought if I had to nitpick, it was way too long. I felt like the very first hour and like the very first fight scene at the IRS agency was amazing. And with Jamie Lee Curtis, like I thought the first hour was great. I thought the second half of the movie dragged a little bit, but it was such a big swing, and it was I give them credit for taking a big swing.
That's a movie that should have been seen in the theater because I was on my phone a little bit because it got long. Like if I saw it in the theater, I would have been blown away.
Yeah, it dragged a little bit, but I thought it was so creative and different and mind blowing. It was good. First episode of Last of Us. Did you see this on HBO yet?
No, not yet. I can't wait.
Okay, like the first 30 seconds of the show, it's like foreshadowing what's going to happen. And you're like, okay, sign me up. I'm in. The other thing, I'm not like.
By the way, here's the thing. It's HBO.
Yes,
it's HBO. You just know.
One episode. Yeah, you knew it was going to be good. Everyone said it was, and it was good. And the funny thing is that I'm so much more willing to believe like a virus spread throughout the earth now that we've gone through the pandemic. It just seems so much more real to me that something like that could happen. And so, yes, all on this show.
I'm actually, when I finished Your Honor, I was not looking forward to. I said that was a lot of fun on Showtime. Bryan Cranston, I had a good time, but I was in for one season. I don't need the second. Guess what? They pulled me back in. I saw the trailer for the second season, and it looks like Bryan Cranston went off the rails, a la Walter White. Like I'm excited.
Should have been a one season show. I don't know if I'm going to watch that. I'm going to let you do it first.
Well, guess what? I'll do it for you.
I'm gonna because I thought the first one was a little out there, but I still liked it, and the ending was good, and I thought it should have been like it should have stayed there.
You have my word. I'll do it. All right. So airplane movies. On the way out there, the outlets had no power. There was no internet and no TVs. So I didn't really do much on the way there. It was kind of terrible. But on the way back,
that's why you need to bring a Kindle with you to read.
Yeah. I had some work to do, so I said, you know what I need? I need a background movie. So I threw on Anchorman, and it's been a long time since I just pressed play from the beginning. God, what a movie!
I think what
a movie.
The hardest movies I've ever laughed in a movie theater: Anchorman and Hangover. Anchorman, I was losing it the entire movie. It blew me away how funny that movie was the first time you watched it.
Yeah, that's really something.
Really is an all-timer. Okay.
All right.
Anything else?
Nope.
All right. Should we yarg up to soft landing again next week?
Let's do it. Yeah. So
right.
Same time next week.
Same time, same place. Animalspiritspod@gmail.com, and we will see you then.